Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us for this segment, we have George Schultze, founder of Schultze Asset Management, to discuss why distressed securities should be optimal for investors. It is great to see you as always, George. Welcome back to Trade Talks.
Thank you, Jill. Great to be here.
All right, let's talk about the Fed for a moment before we get into some picks here. Chairman Powell is threatening to keep raising rates, but do you think it feels like the Fed is starting to cave, and how so?
It does feel a little bit like they're starting to cave. I mean, lots of people in the market are now talking that are expecting interest rates will climb to maybe 5.25% to 5.5% this year, which is just a little bit above, 4.75% that we're at right now. But at the same time, we're seeing serious inflation still. And frankly, if they were very serious about cutting this inflation, they would be jacking up interest rates more. They could be as high as 8% or something. That would really send a needed shock to the system and potentially give more value to money. In effect, people that buy treasuries yielding 4%, 5% or so, they're guaranteeing themselves a loss after inflation. So they are baby steps. It is restrictive monetary policy, but they could do more. However, one thing lots of people aren't talking about is that they're also reducing the size of the balance sheet. The Fed balance sheet, which grew to $9 trillion, during COVID, but at the same time, really not that rapidly. So they could do a lot more, but I think they're trying to, aim for that elusive soft landing, and maybe they'll get there this year. We'll see.
So it sounds like we really may need to suffer through a real shock to the system if they're serious about combating inflation, because George, it's so interesting. The equity market and the bond market, they seem to be digesting what the Fed is telegraphing very differently.
I think that's right. And every time you get macroeconomic news, like, this record low unemployment, expansionary fiscal policy, things like that, new laws that, promise additional spending, it gives people optimism. And I think you're seeing it most in the bond market at the long dated part of the curve. I mean, that's why the yield curve is inverted. People are still buying those long dated treasuries. And in reality, though, the inverted yield curve is telling you there's likely to be a recession sometime in the next, say 12 to 24 months. At the same time, equity markets are really volatile. Last year was a big loss. We had a pretty nice recovery in January, but now, so far this first quarter looks really choppy again, and people are concerned that earnings will be down. Volumes are going down for lots of companies in terms of top line revenue, and practically every company is suffering from inflation. So there's just a lot of challenges in the corporate world that make equities difficult to invest in. And if nothing else, they're just volatile and close to peak valuation still. So very different picture for the equity market versus the fixed income market. And frankly, I think it's a time like this that generates more distress among companies overall. With the rising interest rates and extreme amount of leverage out there, it's just more and more likely that you'll see more bankruptcies going forward.
Yeah, and we saw that through the earnings season. Of course, forward guidance, it was all about margins. It might necessarily be sales, but margins, to your point, with inflation and so forth, they can only pass so much on to the consumer. So, and George, you're advising clients to focus on long and short investments in distressed securities. What's the rationale behind that?
Yeah, thanks, Jill. So on the short side, we'll start there. Companies that face distress and bankruptcy, it's just likely that their shareholders, it's more likely in this environment, with rising interest rates, a potentially slowing economy, maybe even a recession, it's just likely that you'll see more defaults. And with that, naturally will become, for companies facing that predicament, potentially massive dilution or complete dilution of their ownership in stock. So that's the trade on the short side. We're short selling companies that are either in bankruptcy or facing bankruptcy and have risk of additional dilution to their shares. A lot of those companies have near-term debt maturities. They may have debt that's trading at pennies on the dollar, well ahead and senior to that stock. And so we think that's a good trade on the short side, because you're short selling, a company stock that, really has a near-term catalyst to go to zero potentially. On the long side, in this environment, there are more and more interesting opportunities presenting themselves in distressed debt. So you can be patient, though. You should be at the very top of the capital structure or as high as you can be. and potentially try to find an equity-like return in that distressed debt. The idea is that through restructuring, those lenders will ultimately become the new owners of the company's, call it post-restructuring or post-distress stock, when it restructures, typically through bankruptcy, but it doesn't have to be through bankruptcy. And then those lenders will have upside from there. It's really an arbitrage between the two. And so we think those are the best opportunities on the long side and the short side. Different opportunities in different sectors and industries, but at a high level, that's what our recommended advice is.
And to wrap up here, George, this market is so dynamic, certainly in macro. How long would you be holding these positions for? Is it more based on price, or is there a time frame that you're going in with this?
It's both. Price-wise, I think most portfolio managers should run their risk guidelines very tightly in this kind of market where there's lots of volatility. So that can get you out of a trade pretty quickly. Things can also appreciate very quickly and become a great trade, so you stick with it for a longer period of time. But generally, our short sales are shorter term trades, maybe 3 to 9 months, sometimes a little bit longer. And on the long side, it can be anywhere from a couple months to as long as 5 years. So that's kind of the range of duration for these plays.
All right, we appreciate the insight as always, George. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Thank you.